Hi, everyone, and welcome to the State and Local Tax Outlook for 2024. During the session, we'll discuss the most significant state and local tax issues for our clients that they'll face in 2024, and along with some action items businesses should be considering during their year-end planning. As states look for more revenue, state and local taxes become more important to your business, so do not forget to include state and local tax in your year-end tax planning. Next slide, please. So today we have a number of speakers from around the country. I'm Jim Bartek, partner at Withum and state and local tax market leader. I'm in New Jersey. I've been working with state and local taxes for clients in all industries over 25 years. I joined Withum over 4 years ago. And also with me is Becky Stidham, a partner in our San Francisco office. Becky has over 14 years experience working with all aspects of state and local tax and joined Withum over 2 years ago. Jason Rosenberg is a principal joining us from New Jersey. Jason has over 15 years dealing with income franchise taxes and other issues related to state and local tax. He joined Withum over 4 years ago, and he's the current chair of the New Jersey CPA State Tax Interest Group. And Jonathan Weinberg is a principal joining us from Las Vegas and has over 20 years experience helping clients with state and local tax issues and been with us for 3 years. Next slide. And the next one. So as far as the agenda, I'll start off discussing the importance of constantly evaluating your sales tax nexus risks. Then Jonathan will discuss assessing market-based sales sourcing rules. Jason will discuss recent developments in Public Law 86272. Then we'll go back to Jonathan, and he'll discuss how mobile workforce telecommuting affects your business. And then Becky will finish up with pass-through entity taxes, and then finally we'll wrap up the whole presentation with some predictions of SALT trends for 2024. And I just want to remind you that after this session, there are a couple other sessions. We do have another SALT session where we'll take a drive to the United States to examine some of the most impactful state and local tax developments from the past year. And during that next session, we will discuss significant SALT law changes, court case decisions, and other policy guidance that are or will impact many of the businesses. So please tune into that session as well. If you do have questions, if we don't answer them during the session, we will connect with you after the session, and we're always more than happy to get on a call. Next slide. So many of our clients have addressed the issue of Nexus for sales tax, however, many companies have not or have ignored it, thinking it doesn't apply to them. Now, while economic Nexus laws do affect some industries more than others, you should talk with your tax team to determine if these rules affect your company. Now, if you're a startup company with expected revenues this year, you should consider looking at this proactively and understanding Nexus so that make sure you begin collecting sales tax once you cross the Nexus thresholds. Because if you have Nexus and you do not collect taxes when appropriate, this could be a significant risk to your company. So I'm not going to cover the Wayfair case in detail. We've talked about that in other presentations. Many of you may be aware of it. So again, we're not going to cover it in detail. But basically, very high level, a company could have Nexus for sales tax purposes if it has physical presence in a jurisdiction. So if you have people, property, independent contractors, visits into the state, again, property or inventory, as I mentioned before. But also, if you exceed economic Nexus thresholds in the jurisdictions, you will have Nexus in that jurisdiction. And each state does have different rules for their thresholds. They could be based on either sales into the state or a number of transactions into the state. So if you have a Nexus in a jurisdiction, you will have to comply with sales tax laws and collect sales tax on taxable products and services, and then timely remit the sales tax to respective jurisdictions. Sounds easy, but a little more complex. The Nexus piece is the easy piece. Next slide. So states have also passed marketplace facilitator laws to capture sales from facilitators like Amazon, Etsy, eBay. So basically, the definition of a marketplace facilitator includes a company that contracts with a seller to sell goods or services, facilitates a sale, and I put the word "or" in there as well, processes the payment. You should know that some states, their laws are drafted overly broadly. So for example, just processing or facilitating could, in theory, give you Nexus and require you to collect as a marketplace facilitator. Other states have written it more narrowly. For example, if you need you would need to have more of a marketplace like an Amazon. So we've assisted many clients who did not realize they actually met the definition of marketplace facilitator. And again, the laws do differ by state. Next slide. So as a result of the changing Nexus laws, we did create a sales tax Nexus calculator that companies can use online to identify how many states they have Nexus in by answering a few simple questions, determine the type of Nexus you have in each state, or actually schedule a call with the SALT team to go over the results. Again, you can access these results for 1 year. You can scan the QR code up top if you want more information, or cut and paste the website or the address that's located down below, or you can just search for Withum Sales Tax Nexus and the page will come up. Next slide. And again, we're not going to go through this next calculator. I just want to let you know that tool is out there. Website will bring you to this page, and there's different options at the bottom that you can choose. Next slide. And you simply, once you click on the option, you want to start answering some of the simple questions. These are the same questions we would ask for our determination if we were doing this manually, such as total revenue by state, where you have employees, where are you filing other types of taxes like income tax or payroll, transaction count by state. Again, there's some states that could cause Nexus based on transaction count alone. Property. There's also a link to set up a conversation with Withum's sales tax team. Of course, you can always call us with any questions or prepare, and we can prepare the Nexus review for you. Next slide. So what are some of the steps you should take at year end regarding sales tax Nexus? What we always say is first assess Nexus. You still have to think about pre-Wayfair, which is more physical Nexus, and post-Wayfair, which could be economic Nexus, or both post-Wayfair. Many companies think they're done once they complete the initial review, but companies must review their Nexus footprint periodically. For example, you may have hired some more remote workers. You could have changed where your inventory is located. You could have increased revenues throughout the year and crossed the thresholds, or you may have added additional services that could be taxable or may not be taxable. You do have to evaluate that, and that does take some time. You should note many states are aggressively looking for companies by sending Nexus questionnaires. They're sending them especially to companies that are registered for payroll and not other taxes or income taxes and not sales taxes. If you do have Nexus, you're going to have to identify the exposure, and identifying exposure can be time consuming. You may need time to remediate some exposure items. So no time like the present to begin this review. And as part of identifying exposure, you're going to need to understand if what you're selling is taxable. It could be very complex. State interpretations can be broad or more narrow depending on the state. So if you're selling a service, it could be difficult to determine the state position, and this could take some time to figure it out with the state. And don't forget to evaluate income tax or other taxes like payroll. Next slide. And we do suggest you start immediately quantifying the exposure. There are ways to reduce the exposure, such as contacting your customers, identify exemptions like manufacturing. They could have resale exemption. There could be ways to allocate services out of the state, or if they paid tax directly to the jurisdiction, or possibly they were audited for that period and your service was included in that audit. So we call it an XYZ letter that we send to our clients and customers. If you do have exposure, voluntary disclosures are available. They limit the look back and generally eliminate penalties. And if you do have limited exposure, you may want to consider registering and starting to collect the taxes. Again, registering as soon as you can, but not before a VDA if you do have large exposure, is important because you want to be able to stop the bleeding. You don't want to keep accruing liabilities. And we've assisted many clients with all steps listed above, as well as setting up a sales tax collection process. Setting up efficient compliance from beginning to the end is key. Since you don't want to miss deadlines, it's important to involve everybody, all stakeholders, legal, marketing, IT, customers, and so forth. You have to consider your ERP invoicing capabilities, automation, such as Avalara, Vertex, or other collection companies. And then the process should include exemption certificate collection. These steps are definitely necessary to protect your company in the event of an audit. And of course, you have to have a good compliance system. And again, we have set up that to help our clients as well. But reviewing Nexus is a simple process. After that, it becomes a little more complex. So be proactive and make sure you consider sales tax Nexus during your year-end planning exercises. With that being said, next slide, and I'll turn it over to Jonathan.
All right, so let's go to the next slide, looking at market-based sourcing rules. So overall, market-based sourcing is an apportionment methodology. So the purpose of apportionment is to compute the portion of income attributable to sources within a state. So state apportionment statutes establish the methodology for apportionment. Now, a state apportionment statute may apportion less than what is constitutionally permitted to the state, but may not apportion more than what is constitutionally permitted. Constitutional limitations include states cannot tax out-of-state income and activity, and apportionment must be fair, distortive of in-state activity, and non-discriminatory. So moving on. So historically, cost of performance was used to source sales other than sales of tangible personal property. So prior to 2014, the Multi-State Tax Commission apportionment provisions of UDIPA used cost of performance sourcing for sales of services and sales other than tangible personal property. Ultimately, in 2014, the MTC shifted from cost of performance to market-based sourcing, and states that conform to the MTC and other states that even don't conform to the MTC started adopting market-based sourcing. So market-based sourcing source sales to the state. The taxpayer's market for the sale is in the state. So moving on to the next slide. So here's a map of states that have currently adopted market-based sourcing. Now, again, there's significant variations in what might constitute the market, but you can see that this map is mostly blue. There's very few states that are green. And I'll also point out that some of the states that are in gray that don't have net income taxes for corporations still use essentially market-based sourcing to source receipts of services for purposes of their gross receipts taxes. So Washington, Nevada, Ohio still use concepts of market-based sourcing for purposes of their gross receipts taxes. So market-based sourcing overall at this point is now the rule, not the exception. So moving on. So things to consider in determining where a business's market is located is, what is a service being delivered? So is it an in-person service? Is it a professional service? Electronically delivered service, a combination of all of the above. The getting an oil change is a service, but that service is always going to be sourced to where the car is jacked up on the lift. It has nothing to do with where the person receiving the service lives or where the car has its license plate. But once you get into professional services, just something as simple as a law firm is a service supposed to be sourced to the venue of the matter, the location of the client, something else. Where is the client going to benefit from that service? I mean, just thinking, of pursuing a patent. Well, in essence, that patent covers the client throughout the entire United States. So should that service be sourced around all 50 states? There's also differences between how a market is defined when the customer is an individual versus a business customer. One of the few uniform concepts in state and local tax is that when your market is to an individual customer, states that use market-based sourcing say, well, you go by the individual's billing address generally. Whereas if you're dealing with business customers, there's a whole cascade of how to define where that service should be sourced. So moving on to the next slide. So again, how do you define the market? Where is the market? Well, some states will say, well, the market is where the service is received, which can be a difficult concept, especially when a service might be received at multiple points of use. I realize that MPU is generally a sales tax concept, but it does come up in the context of defining where a market for a service is. Where is the benefit of the service received? Again, that can be difficult to define. Where the service is delivered, Also where the customer is located or where that contract is managed and controlled. If you can't define all of those, some states will say, well, you can use a reasonable approximation, which might look to essentially a population-based approach. For example, California is roughly 10% of Americans live in the state of California. So in theory, California, they say, well, we'll use a reasonable approximation. Well, they just get 10% right off the bat. And also, there's always questions about whether a taxpayer is required to look through to the location of their customer's customer if these services are being bundled up and then essentially resold in a business context. So ultimately, with market-based sourcing, you can have multiple states claim that they are the market, resulting in the same dollar of service receipts being sourced to multiple states. Then you throw in that there's still, 10, 15 states that use cost performance sourcing. If you are rendering your service or if you're doing the work for a service in a cost of performance state and your customers are in market states, you're guaranteed to have multiple sourcing because the cost performance state is going to say, well, we get the receipt because you did the work here. And then you have all the market states saying, well, the contract is managed and controlled here, so we get it. Another state says, no, well, your customer is benefiting from the service here. We get it. So the potential for having multiple states claim the same dollar of income is very real and very likely. And then on top of it, because of economic nexus standards, states that use market-based sourcing, the methodology for determining the taxpayer's market may also determine if they have nexus in a state. If you just say that, well, $100,000 gives you nexus using Wayfair nexus standards, which every state has its own nexus rules with economic nexus, but you just say $100,000 worth of sales. Well, if you have a customer that benefits $100,000 from a service, that very well may create nexus. If you have a $100,000 contract with someone and the state says, well, we look to where the contract is managed and controlled, well, that very well may be creating nexus in that state. So again, taxpayers who are providing services need to examine how market-based sourcing affects their apportionment as well as their nexus footprint. So moving on to the next slide. And that takes us to 86-272.
Great. Thanks, Jonathan. So we're going to, for those who aren't familiar with PL 86272, PL 86272 is federal law enacted by Congress, and it limits states' authority to tax businesses that only sell tangible goods, provided a company's presence in a state is limited to certain activities. The federal law is one of the last remaining tools in the toolbox that allows for planning around state tax nexus. PL 86272 was enacted in the late 1950s, and for many years, companies such as wholesalers and retailers that are in the business of selling tangible goods have relied on this federal law to shield them from state income tax liability. As PL 86272 was enacted over 60 years ago, Congress, of course, did not consider the impact of the internet and digital commerce age that we're in today. So in 2021, the MTC, the Multi-State Tax Commission, which is an intergovernmental state tax agency that represents nearly all of the states in one form or another, and one of its responsibilities is to assist with interpreting the federal law 86272 on behalf of the states, while they, in 2021, adopted a revision to its interpretation in order to take into account internet activities. This revision made to the MTC interpretation could now result in businesses losing protection, 86272 protection, simply by having routine interactions with customers through the internet. So this is really important, right? As businesses that sell tangible goods may now simply be subject to income tax in another state, regardless if they step foot in that other state, merely by selling goods via the internet that exceeds a deemed unprotected activity. So the MTC's revision, right? This revision was one of the most significant developments in state and local tax. as really what happened is businesses could now be losing one of the last remaining lifelines that they've used for many, many years to shield them from economic nexus. Since the 2021 revision by the MTC, we've seen a handful of states, either through regulation or administrative changes, adopt or at least start considering adopting the revised MTC interpretation, which we'll talk about in more detail in just a little bit. It's important to highlight PLE 6272 only protects businesses from income tax, not from sales tax, gross receipts taxes, not net worth taxes, or franchise taxes, or minimum taxes, or any other type of tax other than income tax. So even if a business is protected by 86272, let's say in California, but the business has Nexus in California by simply having remote sales in California, the business would still be responsible for filing a California return, paying its minimum tax of $800, but they would claim 86272 on their California return, shielding them from California income tax, but would still, of course, be required to file an income tax return in the state and again, pay the $800. Often this gets missed by businesses that believe they would be, protected by 86272, but some of these other ancillary type of taxes, like the minimum tax in California, right? They often get surprised by receiving a notice. And although $800 to many might seem small, when you start multiplying that by 15 years of unfiled returns with penalties and interest, all of a sudden that becomes, $30, $40, $50,000 of exposure. So it's important to keep in mind, right? 86272 can be a wonderful tax planning tool, but it's not 100% get out of jail free card either. So, what we would expect is that, while if a business is deemed protected, there are still going to be, in many cases, multi-state income tax returns that need to be filed. So, moving on here. So throughout the history of the MTC interpreting PL 86272, there have been 5 different interpretation versions to date that the MTC has published, which prior to the 21 revision, you'd have to go back 20 years before that, since the MTC last revised its interpretation on the federal law. As I mentioned, right, PL 86272 is federal law. So most states heavily rely on the model interpretation that's published by the MTC. So often what we see is that the interpretation by the states of what activities would be protected and what activities would be considered to be unprotected are largely the same across the states. And in many cases, the interpretation across state lines are often identical. Where states do differ in interpretation is usually going to be very nuanced or very unique activities. And there might be certain reason or history between why those certain activities, there could be differences amongst the states. But by and large, most activities between states are consistent in terms of interpretation. As the MTC revision was unanimously passed by the member states, there's an expectation that most states are eventually going to adopt MTC's latest interpretation, or at least many of the themes and provisions of the interpretation. Now, that might take many years for some states to adopt as either regulatory rulemaking process, if that's the route a state takes, can take many years, right? It could take a long time for states to adopt this via regulation, or it might require a statute in other states. And simply, right, we may see some other states take a less formal approach without or very little notice and just start enforcing it on audit, right? They might not pass a law, they might not necessarily apply it via regulation, they may just enforce it via audit. And so, there's going to be a wide gap in how states approach adoption of this new revision. So let's jump into some of the particulars here. Let's take a first look at some of the activities that remain protected even to this day with the MTC revision. And a couple of these just to kind of highlight, right? So these are the activities that remain protected even with the interpretation being revised. First one we can see here, selling only tangible personal property via a website that allows customers to search for products, read product descriptions, select items for purchase, choose delivery options and pay for the item. So a very simple website that has minimal interaction with the customer, then 86272 would remain protected under that premise. Number two, right, providing post-sale assistance to in-state customers by posting a static list of FAQs, that would remain as a protected activity if the website only is performing that activity. If the website has cookies on the website, right, on using to the customers via computer or other devices, which the cookie's purpose is strictly limited to gathering information that's only used for purposes that's ancillary to the solicitation of orders. All right. So, for example, if the cookies just remind a customer that they added a product to the to the shopping cart, to the online shopping cart during a web session, and that's all the cookies are used to do, right? That would be deemed as as a protected activity. So again, these are some activities that remain protected. Now let's jump into what I think is more important, right? Let's take a look at the activities that were previously believed to have been protected prior to the 21 MTC revision, but now according to the MTC would result in loss of 86272 protection. Now, keep in mind, right, as we look through at some of these activities, Congress did not pass any new law. Right. There's been no case law that's been developed that resulted in this change. All what has occurred is that the MTC, right, which is the governmental body that represents the states, has revised its interpretation to suggest that all of a sudden now these activities will result in a business losing protection. They've, considering it's a new age, the internet age, and so they've revised their interpretation. So number one, this will be deemed unprotected is providing post-sale assistance to customers via electronic chat or email. So this activity is pretty broad, is going to impact a lot of taxpayers, a lot of clients, a lot of businesses, right? I find this one to be interesting because in the past, under 86272, as it was enacted by Congress in the late 1950s, it was always viewed that if a business provided a customer service via a 1-800 number, right, customers calling up, that wasn't ever considered to be unprotected, right? You call, let's say, headquarters, which includes customer services, right? Customer service. Let's say they're in Washington State. You taking phone calls with customers all across the country, never physically stepping foot in, let's say, the other 49 states and using a 1-800 number to provide customer service. That was always deemed to be a protected activity. But now, apparently, according to the MTC, by using electronic chat, taking that customer service online to a web chat, or even using an email link, right, that is going to result in the loss of 86272, according to the MTC. Now, I'm not going to read through every activity here. I'm just going to highlight some of the ones that I think are going to impact clients a bit more, or businesses a bit more. We can see here in number 4, placing cookies on the computer. So there was, activities with cookies that are okay, and there's activities with cookies that, according to the MTC, are not okay. And the way they differentiate that is that if cookies are used to adjust production schedules, manage inventories, or develop new products or offer new products for sale, according to the MTC, that would now result in the loss of protection and essentially be, subject to business to income tax filings in that particular state. Also, what we see here is that, according to the MTC, just to highlight number 5, that the business remotely fixes or upgrades products by transmitting code or other electronic instructions to those products via the internet, such as any smart device, right? That's going to lose protection under 86272. So this is also going to encompass a lot of businesses, right? Because many products these days are connected to the internet, can be updated from a remote basis, using software code, and would fall under, this new revision, this new activity. Again, there's a few other activities that could throw a company out of protection, but those are the three key ones I do want to highlight, as they're pretty encompassing and broad and are going to impact a lot of businesses. So in terms of actual state developments, now that we've discussed the revision, let's talk about what we're seeing at the state level in regards to adopting the MTC revision. Following the August 21 MTC revision, right, through 22, only a handful of states have provided any guidance with respect to the newly adopted interpretation. First, we saw California issued TAM, known as 22-01, to explain its position on how they would view the revision, right, and how that would apply. The California guidance is generally consistent with the MTC version, but it's not clear if they would apply it on a retroactive basis or not. Then we saw New York update their interpretation of 86272 by updating its draft regulations. So those rules would conceivably be more enforceable, since those rules will be codified by regulation. However, New York regs remain in draft and have not yet been finalized. They've been in draft since 2015, the original first draft of the regs that have been revised over the many years. But they are expected to be finally adopted very soon. So when they are, assuming that they will be, that will, it will have provisions and rules on 86272 with regard to the MTC's internet interpretation. And then more recently, what we've seen, and I know it's not on here, but it's a very recent guidance. We saw New Jersey announce technical bulletin TB 108, which is their interpretation of the MTC revision. With New Jersey's technical bulletin that recently came out, it appears that New Jersey generally adopts the MTC interpretation, but there are some nuanced differences. For instance, based on the bulletin's guidance, New Jersey seems to have a significant higher threshold when it comes to the cookies activity. So, according to New Jersey, 86272 is only lost when a business not only places cookies on a company website, but also sells the information to third parties that it collects from the use of its cookies on the website. So this is one instance where the MTC took a much broader approach, and New Jersey isn't necessarily seeing eye to eye with the MTC when it comes to that particular activity. So again, the one thing to keep in mind, right, not only are states going to adopt a lot of these interpretations, but they're going to do it with a lot of difference of opinion with those interpretations. So this is going to result in where historically we saw a lot of conformity and consistency between state interpretation. Well, when it comes to the 21 revision, these specific activities, we do expect that there are going to be a bit more differences between states and how they interpret and what they interpret and what their guidance is. So in closing here on 86272, as I mentioned, right, we've seen 3 states that put forth concrete guidance or regulatory rules that adopt 86272's newly revised interpretation. We've seen signals from other states such as Oregon, Minnesota, and some others that are putting out or plan to put out, have suggested to put out, that they will be putting out guidance or policies in the very near future. As I mentioned earlier, right, we expect that many states are going to adopt this, but it could take many, many years. We expect some states to take a wait and see approach until some of the litigation is settled early on. So we expect this process and this adoption to take many, many years. It's not going to happen all at once. So the bottom line is we're not advising that all businesses should just simply concede to the new MTC revision. We advise that, first they review their 86272 analysis under the old interpretation, make sure that they pass, and then take a look at how they're affected by the new interpretation. So with that, I'm going to hand it off back to Jonathan to talk about the mobile workforce.
Yep, and we can go to the next slide. So telecommuting is something that really got kicked off with COVID, and the complexities that go along with it, I think, are permanent. That telecommuting is here to stay, and taxpayers are going to have to deal with the issue. So states and taxpayers continue to deal with the impact of a mobile workforce, especially as what were originally intended as temporary remote work arrangements have now become very permanent. So issues that are put into focus with telecommuting are income and sales tax nexus, income tax apportionment, and state payroll withholding. So moving on to the next slide. So telecommuting's impact on Nexus is, so Nexus is defined as a contact with the state is sufficient to establish a connection, allowing the state to impose a tax. It requires the business to possibly register, collect, and remit sales taxes on sales made within the state. It also requires a business to possibly file an income, gross receipts, and or net worth tax return. So types of nexus include physical nexus. So again, once you have a mobile employee that is located within a state, that is definitely a nexus creating activity. We can also have economic nexus. So you have factor presence with a bright line threshold, for example, $500,000 worth of sales in the state, or other states use just using doing business within the state, which is generally defined as deriving receipts from in-state sources, which takes us right back to the market-based sourcing section from before. So moving on. So, examples of mobile workforces creating nexus, we have ASAP Cruises versus Wisconsin. So Wisconsin determined that a resident employee creates nexus for income tax. So the taxpayer was selling travel services through independent travel consultants who were Wisconsin residents doing business in Wisconsin. So Wisconsin said you are now required to pay corporate franchise tax on your net income derived from Wisconsin sources. Additionally, the taxpayer in that case argued that they were protected under 86272. Wisconsin counter said, well, 8672 doesn't apply because you're not selling tangible personal property in the state, you're selling travel packages. So again, having a mobile employee located in the state is certainly sufficient to create nexus. So moving on to the next slide. So again, a handful of states have issued guidance that employees temporarily working remotely during an emergency declaration did not create nexus, but all state emergency COVID declarations related to nexus have expired. So again, while many remote work arrangements were intended to be merely temporary at the outset, these remote work arrangements have now become very permanent. So again, those employees that scattered to the wind during COVID to work from a second home, a family home, or just move someplace that they found to be better for their lifestyle, employers now have nexus in all those jurisdictions. And again, it's important for businesses to consider its policies in respect to remote employees, because once you allow an employee to work remotely from a state, you are signing up for income taxes, potentially sales taxes, and of course, payroll taxes in those remote states. Moving on. So again, telecommuting income taxes on apportionment, there's potentially rough and smooth. There's good and bad. So for income tax apportionment, some states, consequent of an employee working from a different state as a result of the pandemic, could affect sales factor sourcing as well as a payroll factor when it comes to state apportionment. So moving on to the next slide. So how do you determine how much income is taxable in one state versus another? Well, that's the concept of apportionment. So again, every state is required to divide the income amongst the states and can only tax income derived from sources derived within the state. So again, historically, states used a model apportionment formula based off of equally weighted property, payroll, and sales factors. But again, at this point, almost all states have adopted single factor sales, or super weighted the sales factor. So the payroll factor doesn't normally factor into how much income you're going to have derived from sources within the state. So again, having mobile employees working in a state that uses single factor sales, if you don't have sales in that work state, well, you might have a filing obligation. You certainly have a payroll tax obligation. You may have sales taxes, but it seems unlikely that you would have an income tax liability in that state, even though you may be required to file. So moving on to the next slide. So again, here we have a summary of the factors. So again, factor components is a property, payroll, and sales. If there is a payroll factor, does that move around? Does it spread the apportionment around? Again, what type of activity do you have? Are you selling tangible personal property where potentially you might be protected under 86272? And is that remote employees activity in the state protectable under 86272? Are you selling services and intangibles where 86272 doesn't apply? And then what are the sourcing methods? With tangible personal property, it's generally destination. With services or intangibles, it's market-based or cost of performance. And again, if you have employees moving into cost of performance jurisdictions, that will create a sales factor in that jurisdiction. On the flip side, if you have employees leaving cost of performance jurisdictions, you may see your apportionment go down because you now have less cost of performance in those jurisdictions. So moving on. So again, telecommuting's impact on payroll taxes. So payroll tax withholding involves deducting income and payroll taxes from employees' compensation before making that payment to the employee. So employees may adjust income tax withheld from comp by providing employers with employee withholding certificate. So again, the most common state tax withheld from comp is income taxes. But again, once employees start moving around, they need to be withheld on in different states. So it's important for employers to periodically poll their employees and remind them to update their state withholding so that way they're being withheld on appropriately. Because remember that employee withholding is a dual obligation, that employees are subject to tax. They're the ones who really pay the income tax, but employers are obligated to withhold appropriately. And if employers don't withhold appropriately, states are able to get that amount directly from the employer. So again, different locations also complicate withholding requirements. So the state where an employee principally lives generally has primary tax authority over that individual's income. However, when it comes to wages, the location where the employee works gets the first bite at the apple for taxing that income. So, that again, you may have to withhold in the location that the employee works, as well as have what's called backup withholding in the place where they live. So then you have other complications. You can have reciprocal agreements between multiple states that say, well, you only have to withhold in his home state. You only have to withhold in the state where they work. So again, you have to look at that. And then moving on to the next slide. There we go. Again, remote workers owe taxes to the state where they work, regardless of the employer's location. But again, we get into states that use a convenience of employer test, where employees could really be subject to double taxation, subject to the state where they're assigned to work, as well as in their home state. And again, the home state very well may not give a credit for taxes paid to the state taxing them under the Office of Convenience of the Employer test. So again, if an employee principally worked in a state other than their home state, but now they're working remotely due to their pandemic or for their own convenience, states may say, well, you remain subject to tax in the assigned work state. Again, there could be reciprocal work agreements as well, that New Jersey and Pennsylvania have reciprocity. Both states have Office of Convenience rules as well, but the reciprocity trumps Office of Convenience. So New Jersey residents working in Pennsylvania, Pennsylvania residents working in New Jersey are only paying tax in their home states. So again, other states use a day threshold to determine if someone needs to be withheld on. So, moving on to the next slide, just getting into Office of Convenience a little bit deeper. So a limited number of states impose a convenience of employer test. So in states that impose a convenience of an employer rule, an employee who is working out of the state may remain subject to tax on 100% of their salary if they are working remotely from their own convenience rather than the employer's necessity. And again, employers are obligated to withhold appropriately on their employees' compensation. So employers may need to withhold state taxes in multiple states under a convenience of employer rules. Employers may need to create remote work policies so their workforce is not caught up in an Office of Convenience trap. So employers may need to create policies requiring employees to work remotely in order to rationalize their rent expense and obtain access to talent in other jurisdictions. So because there is a significant difference in an Office of Convenience state where if the employer raises their hand and says, may I, they are likely subject to convenience of employer rules, where if an employer points the crooked finger and says, you will, then the employee is likely not subject to the Office of Convenience rule. So again, remote work policies may also need to address employee expense reimbursement and support for remote work. So for example, supplying technology resources, cell phone and internet reimbursement, travel reimbursement when the employee needs to come back to the home office or come back to the main office. And there's one case to watch right now, which is Zielinski versus Tax Appeals Tribunal. So Professor Zielinski has revived his case and arguing that the convenience of employer rule in New York is unconstitutional, at least during the periods when businesses were closed due to COVID-19 mandates. New York has been a little disingenuous in saying, well, we are telling people to not come into New York during COVID. Non-essential businesses are closed. You can't come in. Oh, but by the way, that is for your own convenience, not your employer's necessity. And therefore, you still remain subject to New York tax on 100% of your income, even though we're telling you you're not allowed to come into the office. So we'll have to watch how that case develops. Moving on to the next slide. So again, here's just a quick map of states that are most friendly to mobile workers. Again, many states, especially the red states, they say that as soon as you have one remote work day in that state, you are subject to tax. Whereas some of the green states allow employees to work for up to 30 days remotely in those states before they are subject to tax withholding. So again, every employer with remote workers or workers who travel need to evaluate what their withholding policies are. So moving on to PTETs.
All right, so we're all pretty well aware now, after about 6 years, that the SALT cap of $10,000 per person is here through at least 2025. Please proceed to the next slide. As of 2020, we would be remiss to not mention PTET taxes, which have become a popular and kind of ever-changing environment for pass-through entity holders to kind of skirt this $10,000 SALT cap. Next slide, please. And we're going to go one more as well. So the general principle is that if you are an owner of a partnership or an S Corp, you may make an election at the state level to pay your state income taxes at the partnership level, and then take the deduction for that state income tax for federal purposes with no cap. So this is applicable to pass-through entities, both partnerships and S Corps. One more slide. As we can see, this has become a very popular trend among states. There are 9 states that do not have personal income tax, so we have not seen, nor will we see, elect PTET tax regimes in those 9 states, which are gray on this map. There's only 6 states that have not enacted a pass-through entity tax, 3 of which have proposed them, but they have not made it through those specific state tax legislatures: Maine, Pennsylvania, Vermont. 3 states have not yet proposed a PTET, which is DC, Delaware, and North Dakota. Now, please go to the next slide. I think the most important thing to take away from this SALT discussion is that as of December 31st, 2025, the $10,000 SALT cap is set to sunset, meaning that the SALT limitation will no longer exist. So 2026, you can fully deduct your state and local taxes and property taxes. It will be wholly dependent on what Congress decides to do or what happens in the 2024 election. But we do know that the new House Speaker, Mike Johnson, has indicated that he is unwilling to bring any tax reform to the floor without SALT cap reformation, whether that means a complete reversal of the limitation or eliminating the marriage penalty or increasing the limitation. So we are really paying a close eye on this in the next 2 years. But as of right now, it's here to stay. And what happens with the states depends on how the states have enacted these rules, whether they expire as of 2025, they sunset with whatever happens federally, or if the state enacted them permanently and needs legislation to pull them back. Now, in our slide deck, I have included various state tax adjustments, various state tax updates that happened in 2023. Those will be made available to you, but we are almost out of time. So at this time, I'm going to switch back to Jim Bartek.
Okay, sure. And Jason, if you can go to the trends, and we'll go through the trends quickly because I know you need to get to your next session. But basically, a couple trends we see out there: broadening of Nexus standards. Jason talked about that. We see rate cuts on corporate and individuals on the income tax side, and of course, broadening on the sales tax side. Exporting the tax burden. States are actually expanding on out-of-state customers, we'll say, so hotel taxes and so forth. Unclaimed property, I'll talk about that in the next session, where Delaware is sending out notices. And next slide. And then, of course, sales tax expansion, a traditional source of revenue decline. They're eyeing the digital economy, of course, which is now over 10% of the GDP. So again, it's something that states are looking at, expanding the definitions in the imposition taxes to digital goods and so forth, as well as gross receipts taxes. You'll see states increasing on that. And of course, you'll see a trend in increased audits as well. So next slide. So with that being said, I hope you enjoyed the session. Please make sure you sign up for Withum's Dash Salt, which provides weekly updates and of state and local tax developments. Of course, feel free to call any one of the presenters with any questions. Again, if we did not answer your question, we'll get back to you this week. Thanks again for joining us for the State and Local Tax Outlook for 24. And be sure to tune into the sessions starting in a few minutes. Thank you again.